So I made a video a few months ago talking about the 4 ETFs that I have in my portfolio. So I also mentioned in that video that I don't like holding ETFs that have the same companies in them. So for that reason, I wouldn't hold 2 high yield dividend ETFs, especially in Australia, because they likely hold the same companies and in similar percentages. It's better just to focus on the one that you like the most. And if you want a second or a third ETF, to look for an ETF that has completely different companies. So perhaps that might be an international ETF, perhaps that might be a small cap growth ETF. That way you can better diversify your portfolio and you aren't doubling up on companies. Now, as a dividend investor, I hold VHY. It represents about 12% of my portfolio, but some of the companies within VHY I also hold as single stocks. A lot of these companies I purchased before I even had VHY, and some of them I've purchased afterwards. So in this video, I thought I would go over the companies that I hold that are also in VHY, since I'm kind of doubling up. So in a perfect world, I wouldn't necessarily need to hold both single stocks and have those stocks in an ETF that I hold. It's essentially owning the company twice, right? But there is a big difference between holding a company within a fund and holding it individually. The biggest reason, of course, is that I can individually control how much of each particular company I hold, whereas I can't do that with a fund. So perhaps I want to buy more of those companies that pay better dividends and less of those companies that pay smaller dividends. And since we're talking about dividends, ETFs usually pay around 4 times a year. They collect the dividends that the company pays them, and then they distribute those dividends to investors around 4 times a year. Whereas if you hold the company directly, you'll get the dividends on the payout date that the company pays out dividends. Now, this can be helpful if you're trying to spread out which months that you get paid your dividends in. So with an ETF, even with all of the benefits that you get with them, you have less control than if you're buying stocks individually. There's somebody else that's organizing which companies go into that fund and what percentage, what allocation is going into that fund. Now, for some people, this is great. There's no research, there's no worrying. Somebody else is doing all the work for you. And I do like ETFs for that reason, but I also like being able to control the companies that I have within my own portfolio. And that to me is the more important factor. The fact that I am able to control exactly how I want my portfolio to be. Now, there are currently 76 companies within VHY, and they range in allocation from about 10% for BHP down to 0.2% for APM. The top holdings in VHY make up about 63%, which is a huge percentage. The top 10 make up a huge percentage of the entire fund. I personally currently hold 13 single stocks in my portfolio, as well as 4 ETFs. And the majority of the companies within my portfolio are high-paying dividend companies. Since all of my individual companies are Australian companies, our stock exchange, we don't have the same number of companies that, say, the US stock market has. We have far fewer companies to choose from, especially when we're talking about high dividend paying companies that also have growth potential. So it's inevitable that there's going to be some overlap. And that's especially the case if you buy an index ETF and you're buying individual companies, you're very likely to be buying the same companies. But how much of an overlap is in my personal portfolio? So of the 13 individual companies that I own, 9 of them are also in VHY. And 4 of them are not. So let's have a look at the 9 that are actually in VHY that I also own. Here they are. I don't have the same percentage allocations, nor do I even have them in the same order as VHY has them. My biggest holding in my portfolio is Wesfarmers. That's the 7th highest in VHY, but the 1st highest in my portfolio. And it's probably mostly because I've had it the longest time and it's grown over that time. So Wesfarmers is 18% of my entire portfolio, which is even higher than VHY. And the reason I won't sell it is because I've held it such a long time and I bought it such a long time ago at a much lower price that my dividend yield, the money that I'm getting back compared to the price that I paid, is just so sweet. I'm not going to sell it. And of course, the 4 companies that I hold that are not in VHY are still high dividend paying companies. So knowing this, knowing that some of the companies I hold are also in a fund that I hold, I actually don't plan on changing anything. If for some reason I decide that I don't want any overlap in my portfolio, I would prefer to get rid of VHY than I would my single stocks. This is mostly because I prefer buying single stocks. I just like it better than ETFs. But know that this is a personal preference and some people prefer ETFs better, and that's perfectly fine. That's the beauty of investing, is that you can set up your portfolio in any way that suits you best. The perfect portfolio is the one that works best for you and helps you sleep at night. You don't want to be stressing about money. You want to be confident in your decisions and you want to be happy with the companies or the ETFs within your portfolio. Anyway, I hope this video has been informative and interesting. I thought I would share and I will see you in the next video. Take care. Bye.